Welcome to the podcast. I'm Eric Salzman, joined with Richie Bennett and Kevin Doherty. And let's get right into it. Richie, start us off with some good news because we got a lot of bad news coming up at the end of this.
Um, well, nothing has changed in terms of the rotations in the stocks. Everybody's talking about AI and how it's destructing everything. But if you look, the RSP is the ticker. That's the equal weighted S&P 500. So people argue about how it's a dangerous market if you have just a few stocks that account for most of the percentage of market capitalization in a stock market. So, the Mag 7 is a little less now, but it's still like this. The seven stocks are roughly 35% of the whole market cap. And then the 493 are just little lemmings. So this RSP, we've gone over it before, but for those who are new, the RSP is just an equal weighting of all 500 stocks. So the Mag 7 doesn't get any more or less credit versus the rest of the stocks. That ETF, RSP, is up 6.4% as of this morning, still year to date, which is pretty good considering everything else is either negative or flat or, trying to break out. Some of these foreign markets are insane, like Korea. South Korea is up like 45% this year. It's only 2 months. The caution there, though, is talk about concentration, like Samsung and that SH Hynix or whatever, SK Hynix, they account, like two stocks account for 40%. So I'm not going there. One day could just change the whole thing. But within the U.S., if you look at the charts of XLE, that's the ticker for energy, XLP, which is the ticker for consumer staples, XLI, which is the ticker for building, industrial, and XL, I think it's B, which is materials, right? So all the nuts and bolts stuff, like hard to decide why or how AI could take over those businesses in that, I don't think AI is bringing oil out of the ground yet, but maybe someday. All those charts, if you look at them, they're all the same and they're like this, woo, like up, 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 and not seeming to stop. So you still have this situation where, in certain sectors, and I'm sure Kevin will get to this, it's a disaster, right? It's like, man, we're down like a ton. But in others, it's actually pretty good. And it's not like skyrocketing. So like if you have the RSP and you're up 6% in 2 months, that's really good. It's really good. But it's not like it's up 20% and you're like, what's going on here, right? It seems like a casual kind of shifting toward these more defensive, old school, shall we say, value stocks, right?
Now, Rich, just to ask you a question. So you had said a few podcasts ago about how, the rule of thumb is what the stock market is doing is telling you what the economy is going to do in 6 months to a year.
Right.
Does that narrative still holds? So in other words, that the real economy still believes that we have an expansion still going on.
Yeah, I think that's also tied to the interest rates. So any kind of sniff that changes, whereas Warsh comes in or gets in and comes in and says something derogatory in terms of lowering rates, that could all shift on a dime, but that would shift everything. Like then you would have, wholesale selling of every product. But yeah, what that's telling us now is like there's going to be some rate cuts, which is going to open the spigots for the economy. And these companies that make stuff and make money are going to continue to do so, which is pretty cool. The other bit of good news that we can't forget, which seems as of today, good news for everybody involved, the Warner Brothers Discovery situation. So last night, Paramount Skydance put in a bigger bid for the company, and Netflix dropped out. This morning, as we wake up, both Netflix and Paramount are up like 10%, the stocks. So what that's telling you is the world thought that it was a bad idea for Netflix to be buying Warner Brothers Discovery. So the Netflix stockholders are like, whew, dodge a bullet by not buying that company. And I guess they viewed that Paramount can make it a better go because of, I think they're going to fire a bunch of people, which sucks. But I think they, and they're buying, remember, Paramount is buying the whole thing. So, meaning Netflix was only going to buy the streaming and the movies and film section and leave the TV thing out. So, a lot of people debate, like, is the TV thing worth anything? But Paramount thinks they can make a go of it, which is pretty funny because now Paramount's going to own CBS, CNN, TNT, Discovery channels, and we'll see how it flies. But so far, good news.
Is Paramount, so that's the one that like Jared Kushner's involved with that one, right? Like he's involved in I think is Ellison also involved in that as well?
Well, Ellison owns the son is the CEO.
Right, so and that's how CBS. Gotcha.
So Larry, the dad, was instrumental because this Zaslav, who's the chairman of Warner Brothers, played this one beautiful. Like he played both sides. They'll write a book about this someday.
And Richie, you've had experience with Zaslav, right?
I have. I do know him.
He made a deal with Zaslav.
I have. And now I'm hoping that there'll be a new deal with the new owners because I think old Dave was in cost-cutting mode and wasn't really renewing new programs, but just running them on repeats on his networks, which cost him zero. Right. And he was able to scrounge some advertising money out of that. And so we're very optimistic in terms of Paramount buying it. I think it would have been harder if Netflix bought it because they weren't going to buy the networks. But right. There's new life in the TV world.
Sounds like Tank 2 is coming out.
Tank 2, ready to go. I'll put a call into Ellison when I can. But that was a key part of it was Zaslav wanted Daddy Warbucks, Ellison, Larry, who has the Bitcoin, but less because his Oracle stock is down 50% since October. But he wanted Larry to personally guarantee like a portion of the deal to make it go. If Paramount's going to buy Warner Brothers, like no backing out because Big Daddy Warbucks has the dough and he's going to back this thing. So I think all that went well. And there was a $2.8 billion breakup fee if Netflix didn't buy Warner Brothers, and Warner Brothers was going to have to give Netflix $2.8 billion, and Paramount even said, we'll give them that. You don't have to worry about it, Warner Brothers. Here, Netflix, here's a check. So they're really flying it around at Paramount, and we'll see how it goes. But again, good news for all involved, it sounds like, right now.
All right. So we got the good news out of the way. And here comes Kevin with the bad news. Kevin, tell us about this this letter that freaked everybody out. Was it early this week or late last week? I can't remember.
Yeah, it was the note was published over the weekend and by a group called Citrini Research, and it basically crystallized a lot of the fears that have been out there about what AI is going to do. And it's a very well written note. It's long. It's worth reading. It's publicly available, so look it up. But basically, to summarize, the note is written as if it's the end of 2028, and it's recounting what AI has done to the economy and what AI has done to companies. And to summarize it, it basically says that AI is so capable of doing all of these white collar jobs that white collar jobs are going to disappear. And there's going to be just this steady unemployment that's going to keep increasing, and that there's nothing really identifiable to replace these jobs. So that, all the accountants, lawyers, financiers, real estate brokers, everybody they're going to lose their jobs to AIs doing those job tasks. And that's going to have an impact on a lot of things. It's going to have an impact on tax revenues, of course. It's going to impact spending because you have all these high spending white collar consumers that are not going to be spending. And so we're just going to have this deterioration across the board in the economy and companies. And then as if this was you couldn't write it this way. Yesterday, Square, so Jack Dorsey, he had founded Twitter before he sold that to Elon. And then he has this payment processing company, Square, that's big, significant. He announced that in a letter, an open letter to his employees, that the company's going to fire 40% of their employees overnight. So they're taking headcount down from 10,000 employees to 6,000 employees. And he said in the letter, this is not because we have business challenges. We're actually continuing to grow. This is because we're able to use AI to replace these employee roles. And so 40% in one go for a growing company, it really crystallized the thesis and the fears that were laid out in this Citrini research letter, and the impact on the market. Monday morning, when the markets opened, the companies that were named in this letter plummeted. They're down 10, 20%. And so everyone is still digesting this and wondering, oh my God, is this a future that we have coming? But in the immediate term, it really it highlights problems in the private credit area. And Eric, I know you've been looking very closely at that, and that's with Blue Owl, we've talked about that in multiple previous podcasts because of the problems that they're having, and that's accelerated this week because they seem to be, as the subprime was in 2008, more and more people are thinking that private credit and its related ecosystem, which Eric is going to talk about, that's the problem area this time.
Yeah. Yeah. So private credit, I remember it was like 2, 3 years ago, and all of a sudden on Bloomberg, it seemed like sometimes every fifth line on the Bloomberg, you get the news headlines, you just watch that, so-and-so is putting $50 billion into private credit. They're just pulling, it seemed like every day, billions and millions of dollars. And I honestly back then didn't know what private credit was. So I looked and I just said, so these guys are just doing boring commercial banking, right? That I thought it was a sexy thing. And it's like they're basically doing middle market lending. But it made sense to me from the standpoint of that the banks after 2008 got regulated pretty much with the revised capital weightings. They got regulated out of that business. And the other thing was before the blow up in 2008, you had CIT. If you remember that, John Thain, and remember CIT, and they were a huge middle market lender. They weren't a bank. They were like a fund that invested huge in middle markets. And they blew up sky high in 2008, and actually for some reason they got a bailout too. They got a few $1 billion from the government, probably because of just the fact that all the lending facilities they had to all these middle market companies were getting pulled back because they had blown themselves up. For some reason, they went from their bread and butter, which was middle market lending. And we define middle market lending. It's defined a few different ways, but generally I see it as 50 million in revenues to up to $1 billion. That's kind of the middle market. And that's the backbone of the country. That's where the most employment is and things like that. So that could be why CIT kind of got bailed out, just so it would have been like a heart attack for for these mid-sized companies, middle markets. So private credit saw a great opportunity, and this is really how things should work, is that, there's a need for capital, and we can provide that for that need. So private credit got started, and I think for a while it made sense. However, and this is before the software apocalypse. This is just like where we are, let's say last November, when these guys got in. A lot of the reason the banks also, it was getting rough for the banks, was because all the mergers and acquisitions that were happening, the amount of banks were getting smaller and smaller as far as regional banks, meaning that there was like 3 banks would become one, and that one bank just didn't necessarily have that local expertise that you really need to have to do this lending. I think I wrote a piece on Racket a while ago about private credit, and I had a great a commenter came in and he goes, "I was a middle market lender." He goes, "This is what you need to do to be a middle market lender. You have to know that thing, and you have to be ready to take it over when these guys, because when things go bad, you have to know you have to recognize they're going bad, first, and then you got to be able to come up with solutions, and you got to really be able to value whatever the collateral is, and really know how to do it." And that made me think, yeah, well, how's a guy sitting at Blue Owl in New York? How is he going to really understand the company that he's lending to? It's easy to lend money. It gets really difficult when your guy starts, when your guy starts not being able to pay you. That's where the real expertise comes in. And I don't think these guys have it. They can't. I mean, you probably have one guy overseeing like 20, 30 different, companies, direct loans at a time. And how's he going to stay on top of all that, really stay on top of it if things go bad? Well, things are starting to go bad. So back in November with Blue Owl, back in November, they had one of their, so they have a publicly traded business development company called it goes, I think it goes by, it's OBDC. That's and most of that is a technology fund. So a lot of it is invested in software, in software technology. And then they had a private fund that was called OBCD2, right? And OB just means Owl Business Development Corp 2. And that is a private one, and most of it is retail money. Like this is high net worth, and really I think back then to buy in, you just had to be an accredited investor, meaning you had to make 250 grand a year, and it wasn't that high of a bar to get in. And a lot of financial advisors put a lot of their clients into this stuff, and things were starting to get rough. And the publicly traded one was trading at a discount, meaning that the Blue Owl is they're valuing the loans and the net asset value at 100, and the market's saying, nah, like we don't, we think the loans are not, we think this is more like 80, not 100. So it was operating at a 20% discount. So Blue Owl had the bright idea that they were going to put the two together for synergies, and they were basically going to take the private one and merge it into the public one, and then it would all trade. And they just basically wanted to lock up the capital, right? Because people were trying to get out of the OBCD2. Anyway, what goes on is the people in OBCD2 go they have to basically swap their shares for the shares in the publicly traded one, and they're like, wait a minute, why am I only getting 80 cents on the dollar for my $100 of ownership in this fund? So they went berserk, and they had a publicly, it was a huge embarrassment. They had to cancel this deal. So Blue Owl was already, and now people started to really look at what's going on at Blue Owl and the other guys, especially the guys who have, like, Blue Owl is very, very concentrated with retail investors. Ares apparently is, I think KKR is. That those guys are it's retail money. And I'll give you a quote that I read over the weekend from Lloyd Blankfein. And if you remember, Lloyd was the CEO of Goldman Sachs, and he now he's retired. So he was talking about this event. And he was basically talking about retail and insurance, and we'll get to insurance money in a second. So this is Lloyd talking about private credit. I think it's crazy to put those assets there. These securities are opaque and maybe riskier than most, but to the extent you're selling it to institutions, people don't care that much. But if individuals lose money, or insurance companies or real businesses lose money, it's terrible. So between Lloyd saying that, Jamie Dimon kind of stuck it in again. If you remember, Rich, you talked about it, where Jamie Dimon talked about the cockroaches, and Lipschitz Lipschultz, I think, I'm sorry, at Blue Owl went off his rocker, and basically, and actually he's made some new quotes that are pretty funny. But he went off, and Jamie Dimon just said, there's some people doing some pretty dumb things. He said, just like 05, 06, 07, the rising tide lifts all boats when everything's going well. But now we're, the Warren Buffett, now we're seeing who's wearing their bathing suit and who's not.
I bet Lloyd is so happy that he's retired and not going to be dealing with any of this nonsense, right, this go around.
Yeah, when I read that, I was like, Yeah, because Lloyd does not, he's not responsible for the bottom line anymore, right? Yeah, I mean, because you know how that business works. If something's working for somebody and it's not working for your two or three competitors, you got to get in, right? You have to get
Yeah.
in. You know, i.e. Stan O'Neill and Merrill Lynch back in '08. The last guy in as the train was leaving the station. So this is all set up before the software apocalypse. Now the software, everyone wakes up one day and says, wait a minute, AI is going to basically replace all these companies, whether it is or it isn't. You know, at the moment, the market is looking at this like, and now with this letter out, wow, like, and who lends a lot of money to mid-size private software companies, private credit. They love it, right? Especially when they can lend to a company whose products is like it's like an enterprise product where these 100 companies use their product for whatever thing, and it's enterprise, meaning it's across the whole company, and it could have their human resources, it could have all kinds of things, time management, client relationship management, all that good stuff is like in one suite of a product. And once you've put that thing in, they call it the moat, right? It's very hard to, if Richie's company decides one day, hey, I don't like that. I don't like this. I'm going to buy another. It doesn't work that way because, it would take you months to basically transition. And so that was always the thing is like, look, software it's a reliable, identifiable revenue stream. Well, now all of a sudden everyone said, well, maybe not. Maybe, others can use AI to do it a lot. Maybe you could build it yourself and do it cheaper. So the whole
There's actually there was a big chunk of the Citrini report that was exactly about that. That these mid software companies, they're just the credit they received was based on them having this recurring revenue stream that was just going to keep going forward and forward.
forever.
One interesting thing I got from someone in my network today. Someone designed using I forget that it wasn't Claude. It was one of the other AI projects. They basically created the Bloomberg terminal, so something with all of the Bloomberg functionality. And as you guys know from the old days of Bloomberg, the reason that guy was a mega billionaire is because every person who worked on Wall Street had to have one of these terminals at their
Yeah.
desk that cost your company $2,000 a month to
Now
have.
it's
And
now
it's
it's
just
$2,600 a month, by the way.
it's insane. So this
And
person,
sorry to interject, but keep in mind, he would always, if you were big enough, he would always negotiate the price if you bought enough. What he would never negotiate was the term of the contract. So if you fire a bunch of people and you have a bunch of empty Bloomberg terminals sitting around, too effing bad.
I think if I recall, you had to give you had to cancel a year in advance.
Oh,
And
yeah.
so
It
you
was
were
like-
you were stuck.
They were
Yeah.
like 2 to 3 years contracts, right?
Oh yeah, it's a 2-year contract because we use it in my consulting. But we did. I don't have it anymore. Yeah, but we each had a terminal, and that was basically our overhead. But it was 2,600 bucks a month, and yeah. So at one point,
Well, now you can replicate that for $200 a month.
yes, so my thing is mortgages, right? So I think I went on to Gemini, which is I actually like that one a lot. That's Google or Alphabet. And I was able to replicate a lot of like I would ask, hey, like I mean, I'm just going to throw out some crazy terms to it, but hey, where's the March April Fannie 5 roll? Freaking give me the answer. Oh, what is the implied financing on that? Gave me the answer. I'm like, holy shit, this thing does it's basically doing a dollar roll calculator. So I started asking, I said, like, how hard is it going to be for you, Gemini, to go and start going through basically go through every CMO, collateralized mortgage obligation, and go through it and basically be able to replicate the cash flows under a certain, using a certain speed. Again, I'm throwing buzzwords out, but it's complex. And you never would have thought anybody could do this a year or two ago. I think these guys are a year away from doing that. Yeah, and that'll good because those guys kill you.
And that's the key takeaway in that report, and that people have, uh, there's this camp that says, oh, don't worry about this revolutionary transformation that's coming to the economy, because every industrial revolution before has actually led to increased opportunities and increased productivity. So the steam, the energy revolution causes much more productivity. The industrial revolution, you go from having craftsmen to people working in factories, and everything gets better and better. But the difference this time is that in all of those previous transformations, you still needed a human to operate the product of the next technology. So you go from horse buggies to cars and trucks, you still need a driver.
Right.
You replace a cow on the farm to a tractor, you still need a farmer to drive it. The Ford invents the production line. Well, you need people to work on the production line, but with AI, you don't need a human in the new role. And so I was kind of thinking about, in the kind of the when the 2010s rolled around in investment banking on the trading floors, there was a big shift from doing like voice trading. So,
Mhm.
you're a sales trader, you got your list of, 40, 50 clients, and you're doing trades with calling them up, doing trades. Things switched to direct market access, to doing, electronic bid and
Mhm.
ask and order flow. And those jobs disappeared. And these trading desks went from having 500 people sitting on the phones all day long to 30 people,
Yep.
and that entire job just disappeared. And those people did not get retrained and in the industry. They became real estate agents. They became teachers. A lot of them, took early retirement and said, fuck it, I'm going to Idaho, where the cost of living is a fraction of what it was in New York. It was gone. And
Yeah. I remember so I was at Bear Stearns in '02 and '03, and I was on the fixed income derivative desk, but I also knew mortgages and stuff. So anyway, they liked how I would do presentations. So one day management had the idea, said, look, Eric, start doing like it'd be like Wednesday night, like Wednesday at 4:30, 5 o'clock. You go down to they had these really cool auditoriums. You can go and you had good technology seats and everything. You could teach or speak. And they said, yeah, like, look, we're gonna. They basically send in all the treasury sales guys, right? They're gonna send all them, and they're gonna start sending all the agency sales guys down too to learn about derivatives. So, and the reason was because what you just said, Kevin, they started all of a sudden there were screens and electronic trading. You didn't need a treasury salesman anymore. And at first, and Rich, you remember these guys. So they go down there and they'd be like, you were keeping them from 5 o'clock. It was client night. Maybe it was Thursday night. It was client night. Like, so these guys had to get out of there, and no one was paying attention the first one. And a senior guy that Richie and I know gets up and he basically says, listen, all of you. And he goes, listen to what he's telling you and learn, because basically that's the future. And if you don't know that, that's it. Like, you've reached the end of the line when it comes to what you have done for the last 20 years. Yeah. And those guys were, and some guys did, the younger guys kind of got involved, but a lot of the other guys, I don't think they ever saw another great, maybe they went and became, brokers at Hill Farm or whatever, but that was it. Like, those guys were gone. And now you're really, you know, uh, now you almost have to, how come there's no dystopian movies yet? Like, where, like, should we all be, you remember, wasn't it the Luddite movement where they'd go and, like, smash up printing presses and all kinds of, back with, like, how come we're not attacking the data, the data centers and shit like that?
It's got to be in the works, right? It's got to be.
Has
They
well,
must be like a bunch of movies being developed right now.
you know what? We should make that movie using AI. You
Yeah.
don't need a Hollywood studio and actors and producers and writers. You can just
Well, you're getting to Richie's going to be he's going to be a voice in our movie. It's called Carbon Con. Richie's going to play a Larry Fink character.
All right.
Anyway,
Do I get a
so
yacht and a
what's
helicopter?
that?
Do I get a
Yeah,
yacht and a helicopter?
yep.
Great.
So anyway, back to this disaster in private credit. So you start looking in and you're like, okay, like what? the thing that really scares you is, all right, so like when so anyway, things come to a head. Software apocalypse happens. It turns out that guys are allowed, they're allowed in this in the private fund, this OBCD, whatever, the technology, the private Blue Owl technology fund. They're allowed every quarter to redeem 5%, to get 5% of the money out. Guys, I mean, they were just going at it, trying to get, everyone was going way over 5%. They were trying to get out, and they slammed the gates down on them. And I think we talked about this last week. So
Yeah.
they slammed the gates down and they said, we're changing our return of capital strategy. Like now we're basically going to sell, we've sold $1.4 billion of loans. And you were raising cash that way because these guys are leveraged. It's not huge leverage. It's 1-to-1. So let's say they have 50% capital and 50% debt. And you'll love it that the fact that the commercial banks who couldn't lend directly, but they lend to all the business development companies and private credit. So they're exposed to. So they sell these assets. And everyone's like, oh, and they got 99.70 cents on the dollar. Great. You find out they sold two pension funds. I think it was CalPERS and Ontario. And then they sold a portion to Kuvare Asset Management. And Kuvare Asset Management is wholly owned by Blue Owl. And Kuvare they own insurance companies. And Blue Owl doesn't own them all. They don't own they own enough to be legally not called an affiliate, but they own a piece in each one of these life companies. And then offshore in Bermuda, that's where they own Kuvare Re Life. That's the reinsurance company, and Blue Owl owns that guy. So here's how it works. So they basically, and Lipschultz came out and said we could have sold twice as much. The demand was huge. But they needed their own insurance company to buy it. And then I read this morning, I didn't know this, that they manage collateralized loan obligations. Guess who bought some of the loans? They're the CLOs that they manage. So they sold 1.4 billion. They needed their own CLOs that they manage, and they needed their insurance company. So that gets you looking into this, and you're like, all right, okay. So it goes into an insurance company. So does the insurance company own a lot of this private credit and private equity, these life companies? No, it doesn't. You look on the balance sheet, it's not there, because what they do is they buy Kuvare Asset Management, which is wholly owned by Blue Owl. It's Blue Owl. They'll buy the assets, and then they will put them into the reinsurance company, and the reinsurance company will basically, the life companies will cede. They can't physically move liabilities, annuities, and things like that. They can't move it to the reinsurance company physically, but the reinsurance company still guarantees it. So it's called ceding the liability, CEDE. So what you've got now is when the National Association of Insurance Commissioners look at this, they go, oh, it's a Schedule D. There's nothing there that really is, and all you see is that there's a dollar amount of assets that are over in the reinsurance company. Everything's fine, right? You have no idea what's in there. It's a black box. And this is what the entire industry does. They all own insurance companies. Apollo's the biggest one, but all of them own insurance companies. All of them own reinsurance companies, and that's the game. You're buying, you have no idea. You just know there's a dollar amount. You have no idea what they own. It's all in a black box, and there's no way to see it. So how do we know? How does the NAIC or anybody know what the real exposure is to our insurance companies? Remember, this is annuity money. This is people's retirement money, right? There's been.
I'm sure it'll be fine. I mean, just because you have related party transactions like Enron,
Right.
and you have a point of failure like AIG, it'll be fine this time.
Right.
Don't worry about it.
And so Rich, you know Weinstein, right? Yeah.
Boaz put in a bid. He said, "I'll buy it all for 75 cents on a dollar, 70 cents on a dollar." And he's no dummy. He's a smart guy. So he's already, so what he's saying basically there is everything in the box is worth about 80, right? So everything in the box, because he's willing to pay 65 or 70. So he's going to make some money, but he let everybody know in the world, I'm willing to buy that. At Blue Owl, you got no problems now, as long as you're willing to take a hit of 30% on your whole thing.
Right.
And, they kind of poo-pooed it or whatever, but he's still there. I'm sure he's still waiting for the bid.
Oh, big time. And I think he's been a consistent critic too and he's been zeroing in on this whole insurance game that they play.
He's the one who knocked down the big whale at JP.
Yep.
He exposed him. He knows what he's doing. He waits for he's like the shark that waits for the bad stuff to happen.
Yes,
he
said his quote was, the wheels of the car are beginning to come off.
Yeah.
Like this is just the beginning. Now, granted, he's talking he hopes his future book of owning these things at $50 but still. So.
But again, sorry to cut up, but
sure.
We talked about this like a month ago or 2 months ago when it first cracked, right? With this Blue Owl stuff, with the cockroach comments, right? Yeah. And we talked about how this is going on when markets are like very close to all-time highs still, right? This was all going on when things were beautiful. Now we've had this software implosion, and it takes a little time, I understand, not right away, but like, what the hell's going to happen in a month or two when everybody's like, oh yeah, they own that software company and they own that, and they lent money to that one and that one. And it's, this is where the flames come out.
Right. Well, the other thing is it's a classic liquidity trap. And we've seen this movie a million times before because they're leveraged. If they start taking losses, then, okay, now they got to either sell more loans because all of a sudden their leveraged component goes up. And you remember, they owe the banks. The commercial banks have lent them a lot of their dough, and they got covenants on it. They've got leverage components on it. So what happens? So let's say that they take a 10% loss. Well, all of a sudden now the leverage gets right because you still got the liabilities, but you just lost $10, right? So now all of a sudden the leverage goes from 1 to 1, maybe to 1.2 to 1 or 1.3 to 1. And then does S&P and Moody's come in and say, we got to downgrade you to junk? As soon as they downgrade you to junk, the bank says, we need more. Like basically you got to straighten this out. The only way they can straighten it out is to sell more assets and then to basically bring the leverage back. And it just becomes a self-fulfilling prophecy because you're going to be selling assets you're selling assets to Weinstein, right? He's sitting there, I'll take them all at 65. And that's assuming that the loans are good, right? That's assuming that if they start blowing up, the price goes to 30, right? I mean, it could be, and this is huge. This is a $1.8 trillion industry. And as far as I know, the only guys that are somewhat protected is Apollo, because Apollo owns 100% of Athene, right? And because of that, all of the money they used to buy this crap or to lend this crap, it's all annuity money. It's not retail. You can't go you can run and try to get your annuity, but you're gonna have to take a hit, right? You're gonna surrender it, a lot earlier than you're gonna take a loss. So because they have that, it's like their capital base is not retail. There's no gates, there's no redemptions. It just works, and that's why they call it permanent capital. Well, even if that happens, that they own a lot of the same crap that everybody else owns. So what happens when the government goes, you gotta, hold on. So the dog was gonna go nuts. So what happens if this all starts happening? Don't you think, and I remember these guys, especially Athene, there's been all these pension risk transfers where big public, like Lockheed, takes their entire pension and says, we don't want it anymore. Here. And they shift it all over to these guys, right? And all of them have been doing it. And Apollo's been doing Athene's been doing a ton of it, right? Well, what happens when ERISA or somebody comes out and says, hey, you don't seem to have do you have the capital to back all this? And they're going to, then they have to, hey, Apollo, you either pony up $10 billion right now to make good on this, or there's going to be a problem, right? I mean, this is all going to happen. And right now, it might happen. Hope it doesn't. But if it happens, nobody has any inkling that this is going on because at least in the housing crisis, you saw people getting thrown out of their homes. You saw, you saw what was happening. This is all freaking off in outer space somewhere for most people. And all of a sudden it's going to be there. And we know our government officials, I mean, look, the Fed, well, I wrote this thing months ago about, I said, the Fed doesn't seem to, they just don't get it. Like that's not really effect. It's not systemic. It's not affecting the banking sector. And that's over there. And it's all capital. So, no, it's not, guy. And in fact, there's retail money. There's a lot of retail money in this. And eventually it all get a liquidity. They said a liquidity problem becomes a solvency problem. That's what always happens. And here we are. And again, I don't know what the answer is because it's like, with subprime, it was like, all right, by 2006, when we started looking at, all right, the loans have all been made and the bonds and derivatives have all been made. And what's left to do but watch the explosion. And that's literally what 2007 was about.
Yep. Yeah, I mean, unless there's some, and I was talking to somebody before too, that what's the other than like this guy from Anthropic, right? He came out the other day, yesterday or 2 days ago, to like, I guess he realized like he's kind of screwing things up, meaning sinking these software companies. So he kind of made a speech about how like, no, we can work together. Like we can help, which is possible. But other than that, like, do you really, like, if you're an equity player, are you standing in the middle of this saying, no, software companies are now very cheap. These are huge opportunities. Maybe, but I mean, in the last couple of days, it happened, not today, but there was some pop in the software sector. But again, like, what's the catalyst? The genie's out, right? You're not putting the AI back in the bottle, right? So it's always going to be there. And now, how can this help the cause? I know Block is a different kind of company, but the guy just fired 40% of his employees and stated it was because of AI, right? Mm-hmm. So like, that's hanging over everybody now. Now, the CEOs sit there and go, huh? And that guy's stock just jumped a lot. That Block stock jumped. Like, the market liked that he was cutting 40% of the people. Maybe we should be looking at that, right? And that'll
be really interesting to see if other companies follow with similar announcements in the near term, because that could really, cause people to get spooked more than they already have been.
It just becomes a self-fulfilling prophecy, right? Because like, let's say you're running a law, let's say, big law firms, right? Well, if all of a sudden I could replace 80% of my paralegals and 20% of my junior associates with AI, I have to do that because my competitor is going to do it. And all of a sudden they may bring down their cost per hour, although lawyers are very reticent to do that, but they bring down their cost per hour because all of a sudden their margin, and if they bring down their cost, I got to bring down mine as well. And it's probably like that with every business. Like, I don't want to fire all these people. But I have to because my competitor's doing it. And that's kind of the end game, I think.
Yeah.
All right. Good news. Give us some good news.
We did end on a somber note.
Let's talk about the gold medals, the hockey gold medals.
That was great, right? That was great. So good. I just liked that his teeth were out. I thought that was
huge. That was something.
He should replace that tooth with a golden tooth.
Yes.
Just gold. Yes. As a smiling reminder every time he opens his mouth that
the monkey on the monkey business. I'm looking here. No, we used
to. When he had it. He had it when you remember he used to walk across the top of the
right. The monkey used to walk.
He would stop and smile, and then the gold tooth would come out. I think he had an emerald ring too.
Yeah, we should have put a monocle on them too, like the Monopoly game. Um, but the what people aren't talking about, which is great. Like I watched that game, the whole game. Right, that last drive to get the goal in overtime, right? When they play 3-on-3, which is awesome. It looks like backyard hockey, right? I think it was the younger brother Hughes, Quinn, the little guy, who also played very well for the Olympic team during the medal honors, medal rounds. I think it's McDavid and McKinnon, who are probably two of the best hockey players in North America, right? Both Canadian.
And Cale Makar. He's got the three best hockey players on the planet.
Super duper stars in the NHL, right? They are converging on Hughes. He flips the puck in between them. If he misses that, it's a 2-on-0 break for the Canadians. They would have won. And they score on that, 30 seconds, 20 seconds later. Like they should, they show every replay, right? In every sport. I haven't seen that replay. Like somebody's got to do it soon.
Yeah, they're showing what they should, because they go into the corner, they come out, because the play that Jack made to strip Makar of the puck, if that didn't work, I mean, because he kind of did a flyby and flicked the puck off Makar, and that's how he got down the ice.
Right.
And if that didn't work, then it was Quinn sitting there by himself, and you got the three best high. I mean, Quinn is almost as good as Makar, but this Canada is just, I get all the feeds and stuff. I mean, this is like apocalyptic. Like, I mean, they are just like, we got to change things up, and it's like you lost one game in overtime.
They don't have they got a good curling team, I think, but that might be, they're not going to send the Canadian basketball team down here to beat anybody, right. And the CFL, Canadian Football League, is fun, but that's made up of guys who couldn't make it in the NFL. So this is their thing, right? So for us to beat them in their game, did you see there was a meme where young Barron Trump is reaching over, whispering into his father's ear, and he's like, "Father, we have defeated them at their own game. It is now time to attack."
Yeah, we won't talk about how the media managed to like ruin it, like within.
Matt wrote about that, right? Matt said something about like how the New York Times could mess this up, like just nasty.
Yeah, guy from the Athletic. I was shocked when I read that, and I was thinking, all right, this has to be some dude from the Times. Like, I know the Times owns Athletic, but this can't be a sports writer could not have written this, and he did. Yeah. All right, boys, good stuff. We'll be back. Kevin, you're on vacation. You're out next week, right?
I'm out. Yeah.
Okay.
But we'll be back.
We'll be back. We'll be back.
I'll give a little teaser. There's all this AI doom and gloom. A lot of it's centered around the AI agents, right? That everyone's going to be able to spin up and do replace all these software functions. Well, the way the AI agents will interact with each other and pay each other is likely to be with stable coins. And so we can talk about that on our next pod.
Awesome. Cool. It's all like intertwined. I would love it.
All right, guys. Good stuff. See you next week.
Thanks.
See you.